Again, a difference of 220 basis points from where the Fed pushed rates down to and where the yield on the 10-year actually went to. Now listen, if we don't close below this neckline today, then it's not triggered and there's nothing that says we have to go down there or the probabilities even favor it. But if you break through that, you go to about 115, that'll probably be 116, 117 in a few days because it's an upsloping trend line. So it keeps on rising as it goes.
Gareth Soloway breaks down a potential market storm. A shocking jobs report has triggered a massive S&P drop, and yields are spiking to levels unseen in years. But that's not all. Soloway reveals a critical technical pattern in the S&P that could spell disaster for the market. Is Bitcoin next in line to feel the heat? Stay tuned. You don't want to miss this.
Look at this drop here in the S&P futures into the open this morning. So big drop to the downside. This was on the back of a jobs report. We came in at 256,000 jobs added in December, right? So again, that was above the 164,000 that had been expected. So almost 100,000 additional jobs added. Now, most people will say they'll revise that number. That's fine. They may. Just remember, it doesn't really matter. Why doesn't it matter? Because the markets are reacting to this number. Just it. So as a trader, all I care about is what's causing the market to make that move. That's what I trade. I trade that price action. Always remember that, guys. Now, whether they revise this down later on, who the heck knows? And honestly, who the heck cares really when it comes to trading? Now, for other reasons, maybe we care. But overall, for trading, the number is what it is, and the chart reaction is what it is. All right, so we have a big drop in the S&P this morning. It was already trading down going into that number by just a little bit, and now we're getting a much bigger drop. Now, yields spiked higher, and that's really the culprit here, right? Let's take a look at the 10-year yield. Here's your 10-year yield. The 10-year yields have been a thorn in the market side now for quite some time. Remember just the kind of the poetic nature of how ridiculous the system is at this point. The Fed drops interest rates by 100 basis points over the last 4 or 5 months. Interest rates go up 110 basis points into today, now 120 when you add another 10 basis points onto that. So again, a difference of 220 basis points from where the Fed pushed rates down to and where the yield on the 10-year actually went to. Again, why is this? Let's discuss. The basics of it is that a strong economy means that there's less likely chances of Fed rate cuts and there's more chance of upticks in inflation. Now, why is a strong economy oftentimes yield or create inflation? Because when people are doing well, and listen, we know there's a divergence, right? You have people that have been invested in the stock market. Well, the stock market was hitting new all-time highs all year last year. The wealth effect made them do well. Then you have everyone else who's not invested that's suffering because of inflation. But for the point of consumer spending, that's the zone that you want to go with, right? That's the zone that you want to go with. So in other words, what we have here is a market that is ultimately pushing yields higher because consumers are doing well, they're spending, and that is inflationary because it's more competition for goods. Okay, so what else do we have here? We have the 10-year yield pushing up. It hit a high of 4.79. It's backing off just a little bit. So the big thing I'm going to be watching today is, do we trigger that neckline? All right. Now, again, a head and shoulders pattern is a bearish pattern, right? Here it is, very clear as day. Okay. Now the technical trigger is basically right here around 58.40, 58.30, somewhere in that vicinity. If this triggers right here, then what you do is you take a measured move, your highest point of the head, drop that plumb line down, and you take that distance and replicate it down here. And I believe it takes us to about 5,600 as a short-term downside target. All right, so again, now listen, if we don't close below this neckline today, then it's not triggered and there's nothing that says we have to go down there or the probabilities even favor it. It's really based on the neckline right in here, this neckline right through here. Does it get triggered or not? All right, so again, and if we flip over to the charts here, I want to go back to this because I think it is that powerful. It really showcases the risk that we're not just at a short-term cycle high, but could it be a long-term cycle high? And the long-term cycle high here is that you go back to your 1929 high right here. So this is just before the Great Depression. You connect that to the high of the dot-com era, which arguably was the last time we had incredible growth and development of technology, the intranet essentially. What would be the equivalent of that today? AI, right? And then could we be putting in something like that? Now again, how do you know how much a market could fall off of this? That's really tough to know, right? In the dot-com dot-com era, you had the NASDAQ falling about 65%, but the S&P only fell, I think, about 40%. That's one option. Or you take the really kind of crazy one and you say, okay, the Great Depression, 85% of the drop in the markets. That's kind of a different story. Let's hope that one doesn't come to fruition. All right, at this point on the S&P are trading down, although again, they're not trading down too much. It looks like on the pre-market, this is the SPY 10-minute, we're upticking just a little bit now.
Gareth Soloway dives deep into the unexpected December jobs report, which far exceeded predictions, sending shockwaves through the markets. The S&P tumbled while yields surged, signaling trouble ahead. Gareth outlines how these moves reflect a strong economy but also fuel inflation concerns. He points to a head and shoulders pattern in the S&P, a bearish indicator that could lead to further declines if a key neckline breaks. Historical comparisons to 1929 and the dot-com bubble suggest this could be more than a short-term dip. Soloway emphasizes the importance of watching critical levels to avoid potential financial pitfalls. Stick around as Gareth transitions into Bitcoin's pivotal support and resistance points, and what this could mean for the broader crypto market.
Next stock that is moving is one that I highlighted as a January effect play, guys. It was one of my favorites. Just to refresh on our daily chart, take a look at this, folks. All right, so not only was Walgreens down, basically trading at, multi-decade lows, but we had this nice little base, almost like a little inverse head and shoulder kind of maneuver, and then you have this trend line right here, which we broke above on that rumor of a buyout, and then look how it bull flagged right here, but like that. Just the mere fact that it's holding that trend line the whole time is telling us something. It's what I call a breadcrumb. It's telling us, hey guys, heads up on this one. This could be headed towards the upside. Today, up about 15% on earnings, again, reporting earnings. And what was one of the things I said to you guys over the last game plans, over the last couple weeks when I talked about this stock, was that they still make like $1.50 in earnings a share. So that puts the PE ratio at like 6. And again, listen, it's not to say that their long-term business isn't in trouble. Maybe it is. But on a valuation basis, when you see stocks trading at like a Rigetti before its massive collapse at 400 times revenue, and you have something at a 6 price to earnings, that's where I start to say, this is interesting. Again, maybe an activist investor, maybe a buyout, maybe just a bounce on a technical basis, and we are getting that today. Now, many people saying, hey, well, where would you short it? I'm not looking to short this today, and I'll tell you why. So number one, it's only up 15%. Number two, it has a lot of shorts, so it could be a short squeeze candidate. And number three, it's at the low end of the chart. I don't like shorting stocks at the low end because they could be, literally, blast off rocket ships to the upside. Those are how people get wrecked very often. It's much better to short something like a Delta that's already at 52-week multi-year highs on the back of good news. Yeah, they had good news, but generally that's already been priced in or mostly priced in with this move up today. Although Nvidia's here, if we look at Nvidia on the pre-market, you can see it dipped on that jobs report. It's bounced back a little, still negative. Overall, Nvidia, nothing's changed from what I talked about earlier this week. Wide range engulfing red candle, nasty candle there, right off double top, upsloping trend line. Again, you can't pick a better technical reversal as you saw here. Downside support today, I'm going to watch this 133 to 132 trend line. Notice where this trend line comes from. On a technical day trading basis, that would be support, but I would not be swing trading it. It's too high up on the chart. You can see again where it's come from January to where it is now. At some point, I do fear this breaks, and then you get that big cascade to the downside. Tesla, let's take a look at Tesla this morning, just see what's going on there. Tesla, again, a down early in the day, trading around this 390, 391 level. For me on Tesla, it stays the same. I'm just looking for this level. Once it gets here, that'll be interesting to see the price action. Does it bounce? Does it start to go back up? Does it break? But this is your first support at around 360 to 359. Again, that would be a level to watch. All right. We got to get into Bitcoin, guys. You guys, I've given you literally the keys to the castle on Bitcoin here. Have given you the resistance levels, the support levels, and once again, that support level tag. Let's go over to the big board and check it out. We've talked about this, right? I kept on saying to you guys, listen, as long as you're staying inside of here, there's nothing to do, right? It's chop. It's chop. You can see broke here, tagged here. Then it pushed back up, tagged again, went back up, tagged here, came down, tagged here, went up, basically tagged there. and there it's tagged. And so again, I always caution people from letting the emotion take over, right? Emotion is your worst friend when it comes to investing. And sure enough, we've seen that price action. So many people were starting to get all excited when it was up here. I understand the emotion, but on a technical basis, as I guided you in this game plan, there was nothing to do. There was no excitement there. Shouldn't have been, because you hadn't broken that level right there. Same thing on the downside, right? I mean, like, again, it is what it is. So now all of a sudden the bears might be coming out of the woodwork and say, oh, well, here we go, here we go. Well, no, nothing yet, right? It hasn't broken. Now, at some point, if it breaks, okay, now that's where, and I've said this before, if you break and confirm here, you're going down here, 74 to 75K, right? If you can break up here, you have 108, so this is gonna be all one level, essentially right over here. But if you break through that, you go to about 115, that'll probably be 116, 117 in a few days, because it's an upsloping trend line, so it keeps on rising as it goes. But again, wait for it. You know, people love to anticipate because they think they're getting an edge. People that anticipate generally take losses, because again, they're using their emotion to push themselves in that direction, and emotion ultimately is what the big institutions feed off of.
As Gareth highlights, markets don't move on emotion. They move on technical and fundamentals. Whether it's the S&P or Bitcoin, key levels will determine the future. Will Bitcoin break through resistance or fall to new lows? One thing's for sure, the stakes are high, and now is the time to stay informed. Subscribe for more in-depth market analysis and keep an eye on Bitcoin's next big move.